My name is Jake. Welcome to the channel. I want to talk about the simple path to wealth with dividend investing using the core and satellite approach to investing. Now, if you're not familiar with these topics, that's okay. I'm going to explain them briefly in this video. And then towards the end of the video, I'm going to walk you through step by step different types of portfolios that you can use or at least lean on for inspiration if you're starting a dividend portfolio. One of the challenges that I faced when I first started learning about dividend investing was there was so much information out there, I really didn't know where to start. And that was really challenging for me because I made a lot of mistakes. I fell into a lot of yield traps. I thought that I could, kind of tweak this and turbocharge it. And it really didn't work out in the end. And after trying to reach financial independence over about 8 years, I finally figured out that, you know what, if I could go back and do things differently, I would do them differently. And I want to share with you some of the mistakes that I made and some of the things that you can do to hopefully not make those mistakes. If this is the first video that you've ever seen on my channel, once again, my name is Jake. Here in 2023, my wife and I, we reached Barista Fire. Now, Barista Fire is not Fat Fire, so we are still working on the side part-time, but we're actually living off of the investments in our portfolio. What you're seeing on your screen here is my M1 Finance cash flow portfolio. This is where I have the majority of my investments. This is where the majority of my dividend stocks are in. I have another account where I have real estate and I have an account for a little baby boy. But for the majority of our net worth, it's in M1 Finance. And we invest in ETFs and dividend growth stocks. And my portfolio, I follow the core and satellite approach to investing. Now, if you're not familiar with that, don't worry. I'll mention in just a second what that is and give you a snapshot of what that is. But essentially, when I'm talking about living off my portfolio, I am actually living off my portfolio. So as I'm getting the dividends in M1, what's happening is I have it set up with a smart transfer that as soon as the dividends hit my account, they are automatically sent to my checking account in M1 Finance. And so it's automatically transferred over to here. And then what I can do as my mortgage comes due, as we have to pay insurance and expenses, car repairs, gas, you name it, all of that comes from this account and it's being funded from our dividend portfolio, but also supplemented from, for example, the income that we get here from YouTube, the ads that you see on my videos, that helps pay for our mortgage. It helps pay for our food every week, everything, right? So that's how I have it set up. So when I say that I'm living off of my portfolio, I am absolutely living off the portfolio, but that means that I'm no longer reinvesting the dividends in my portfolio. So if you look at my, the account balance in my portfolio, it really hasn't grown very much. The investments that I'm invested in, they're not 10xing overnight. I'm actually living off of the income. So I'm not reinvesting the dividends and I'm not adding additional, investments. I haven't added any money to this account in 2023. Okay, so that's kind of the reality of what it looks like to live off of your portfolio. So about a year ago, I made a video titled The Simple Path to Wealth with Dividend Investing, where I compared investing into SHD and DGRO with investing into VTI. Now, if you follow the traditional FIRE movement, it's, talking about investing into VTI or VTSAX, the 4% rule. I'm doing it a little bit different because I'm focused on the income or the cash flow from my investments and not selling the shares. Okay, so it's pretty different. So this video and my take on this is very much inspired by The Simple Path to Wealth from J.L. Collins. Now, J.L. Collins is really focused on the 4% rule, just investing into VTSAX, the total U.S. stock market, and not selling your shares. Now, what I'm doing is I'm focused more on a dividend investing approach and where I'm not going to be selling my shares. So this video is very much inspired by J.L. Collins. So that's the simple path to wealth. Now, how does that fit in with the core and satellite approach to investing? Now, the core and satellite approach to investing is not unique to dividend investing, but the way that I view it is your core portfolio is made up of a small handful of ETFs, and that makes up the bulk of your portfolio. And the satellite positions can be smaller positions. They can be ETFs or individual stocks. And here's the thing. everyone can have their own interpretation of what this looks like. I'm sharing this from my perspective, and I'm sharing this with you that I wish I would have done what I'm going to share with you today. I wish I would have done this 8 years ago, 10 years ago. So I made a lot of mistakes along the way. If I would have done it simple like this, I would have saved myself a lot of headaches, a lot of dividend cuts. Okay. And so my approach, how I view the core and satellite approach to investing with the simple path to wealth, is that your core makes up a small handful of ETFs. For me, that is SAHD and DGRO, like I shared in my video a year ago. And then the satellite positions, generally, if you're going to have individual stocks, you don't want them to represent more than 5% of your overall portfolio. It's really just risk management. And then you could also have ETFs in there that make up a larger percentage. Okay, so that is the core and satellite approach to investing. Now, the portfolios that I'm going to share with you are based off of different time horizons. So everyone's in a different time horizon. Someone that's in their 50s or early 60s, they're going to have a different time horizon than somebody that's maybe in their early 20s or 30s. So the way that I kind of think of this is kind of like a target date fund, right? Where you just invest into a fund that will automatically rebalance each year as you reach, as you get closer to retirement. And it's just really easy. You just invest it into one single thing and it just automatically adjusts for you. What I'm going to share with you is kind of similar where, you kind of set it up in that way, but it will require you to kind of adjust it on an annual basis. This is not something that you're going to fiddle with and change and update every couple of weeks or every month. And that's why it's called the simple path to wealth. This is not an investment strategy that you have to actively manage. This is a very passive way to investing in the simple path to wealth with dividend investing. And I wish someone would have shown this to me when I first started learning about dividend investing. I had to do all the heavy lifting myself through trial and error. Because you're watching this video, I'll do some of that heavy lifting for you. In fact, I'll casually carry you through this and how it all works, and it kind of will look a little like this. Oh my gosh. I love it how he just casually picks it up and puts it in there and then the lamb walks by. Oh man. All right, cool. So what I want to do next is I want to walk you through different time horizons on how you can adopt this type of strategy yourself, or at least use it for inspiration. And the links to all of these portfolios will be in the description below. Let me walk you through some of the logic behind why I have it set up this way. If you want to follow the simple path to wealth with dividend investing using the core and satellite approach to investing like I do, this is how you could consider it. So if you have a 20-year time horizon, meaning in 20 years, you plan on living off of the dividend income from your portfolio. Kind of like how I described at the very beginning of the video, where you're no longer reinvesting the dividends, you're transferring the dividends to your checking account, and you're using those dividends to pay for your water bill, your electric bill, for your internet, etc. Okay, this is how you can view this. And it doesn't matter if you're 40, 20, or whatever. It really just depends on when you plan to no longer reinvest the dividends and to fully live off of your portfolio. For a 20-year portfolio here, what I would recommend considering is that you have as your core be SCHD and DGRO. And really, to keep it simple and straightforward, this is going to be your core, and you're really not going to change this much over the next 20 years. So if you're investing into this for a 20-year time horizon, you're investing 40% into SCHD, 40% into DGRO. And then for me, for example, with a 20-year time horizon, I really like DGRW. This is a dividend growth ETF from Wisdom Tree. I've done a lot of research on this ETF. I personally really like this ETF. The only drawback is it does have a higher expense ratio, but it does pay a monthly dividend. And as I'm living in early retirement, I'm appreciating the monthly dividend even more. So this is just a personal example. You could substitute this with, VTI or VIG or whatever ETF you want. But for me personally, if you just want a high quality dividend growth portfolio and you have a 20-year time horizon, this is one that I would highly recommend you consider or at least build off of. Now, if we take a look at a different time horizon between 11 and 20 years, now this is a pretty long span, right? It's about 10 years. But if you're in this time horizon where you think, hey, within the next 11 to 20 years, I'm probably going to want to retire or live off my portfolio, this is a portfolio that you could consider. With this portfolio, you have a decent expense ratio. You have a little bit of a little bit of a higher dividend yield. So the yield is a bit higher. But here's the thing that you'll notice. We didn't change anything to SCHD and nothing with DGRO. This is your core. This does not change, at least in my opinion. Now, this is how I would set it up. You don't have to, but this is my recommendation. Next, we saw here that we had DGRW in the last one. What I did here is I reduced the percentage into DGRW and I added DTD. This is the Total U.S. Dividend Fund from Wisdom Tree. I like this ETF. It pays a monthly dividend. I don't invest in it yet, but I intend to invest in this ETF in the future, in terms of full disclosure. It does have a higher expense ratio, but it does pay a monthly dividend, and I like the fund. I like the methodology. This is just an example. Okay, you could substitute this with any other ETF or individual stock, but in my opinion, if you want to keep it simple, this is a portfolio that you could consider. Okay, and so this stays the same, but we decreased the percentage into DGRW and we added DTD. An example, you could replace DTD with VYM. That's something that you could absolutely do. Now, moving on to the 6 to 10 year time horizon, what you'll notice is the dividend is very similar. It's gone up just marginally, just a little bit. But what you'll notice is SHD and DGRO are the same percentage at 40. I kept DGRW at 10%, but I lowered DTD to 5%. And I added 5% in DHS. This is the Wisdom Tree US High Dividend Fund. It's a monthly dividend ETF. It does have a little bit of a higher expense ratio, but I personally like it. I don't invest into it today, but I can see myself in the future investing in it. But once again, this is just an example of how you could view this. But the key thing that I want to mention here is this doesn't change and this doesn't change, but your percentage to your satellite position. Remember, DGRW is a satellite position. And as I get closer to retirement, I'm going to adjust the new capital, the new money that I'm investing, I'm going to adjust it in my satellite position. Do you understand that? That's the key thing here, is as you get closer to retirement, you're adjusting your satellite positions. Okay, that's the key thing. With your core positions, with the simple path to wealth with dividend investing, you don't really need to adjust them. You don't need to. You could, if you wanted to, you could adjust DGRW and DGRO and SHD a little bit. I don't think it's really that necessary, but you could. Okay, that's the beautiful thing about the core and satellite approach to investing, is it provides flexibility. Lastly, with 0 to 5 years, this is going to be a little bit different because we have a different ETF in here. So when you first look at the dividend yield, you can see that the yield has gone up. Expense ratio is about the same. So here we still have SEHD at 40%, DGRO at 40%. We lowered DGRW to 5, and then we kept DDT at 5, DHS at 5, but we also added a cover call ETF in JEPQ. Okay, so the reason why we didn't have it before is because this is a cover call ETF, right? For many reasons, like the tax implication, the growth that you would reasonably expect with a cover call ETF, you don't want to invest in that if you have a 20-year time horizon. But if you're nearing to retirement, then yeah, absolutely, in the next 5 years, you could slowly start adding it. So that's the key thing. Whenever I see people investing in their portfolio in their early 20s, a lot of times the mistake that they make is they set up their portfolio in their early 20s as if they're going to retire. They have a 20-year time horizon, but they have it set up as if they're retiring tomorrow, right? And so like a target date fund, you can adjust it as you get closer to retirement. Does that make sense? And so with a portfolio like this, how many things did we change over the last 20 years? We went from the 20-year time horizon, we had 3 funds in here, very simple, to this after 20 years, right? It adjusted to this. This is not something that you're editing and changing every couple of weeks. This is a portfolio that you set it and you forget it so that you can go back to enjoying other areas of your life. You can go jet skiing on the weekend. You can go and spend time with your family and not have to stress and lose sleep over your portfolio. And that was the mistake that I made when I first started learning about dividend investing. And it's partly due to influencers on the internet who told me something that really wasn't the right approach for me. And I listened to them. And I don't blame anybody, but I did make a lot of mistakes. And for me, I think the majority of people, if you're new to investing or if you're early on in this journey to financial independence and you want to retire early with dividend investing, I think this is an approach, this is a foundation that you can build upon that will set you up for success. I hope that this helps. I hope that you learned something new, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.